Welcome to the deep dive. The economic landscape is definitely buzzing right now, and there's a big reason. Just this past September 18th, the Federal Reserve cut interest rates by, well, a pretty significant 50 basis points. That's the first cut like that since March 2020. And you saw the impact almost immediately, especially in the housing market. The median 30-year fixed mortgage rate, it dropped down into that, 6 to 6.2% range. Plus, housing inventory has been climbing, up 36% from last year across the U.S. That's 10 months in a row of increases. For a lot of people, that feels like a green light, maybe, for buying a home.
It definitely feels like a shift, yeah. But it's creating opportunities and some pretty public worries, too. While potential homeowners might be feeling optimistic, you have figures like President Trump openly criticizing Fed Chair Jerome Powell, blaming the Fed's rate policy for high housing costs, pushing for even lower rates. But this is happening while inflation has stayed, well, modestly above the Fed's own 2% target, even with GDP growth hitting 2.8% late last year and unemployment pretty low at 4.2%. It's a complicated picture.
Absolutely. It's complex, and the stakes feel really high. You mentioned the criticism. Even major figures like Ken Griffin, a big Republican donor, warned about it. He said publicly criticizing the Fed like that carries steep costs. Risks like higher inflation and higher long-term rates may be shaking investor confidence. So the big question is, are these rate cuts paving the way to prosperity? Or are we, playing with fire here? Are there hidden dangers? Our economy is indeed buzzing with debate as recent interest rate cuts spark both hope for homeowners and warnings about unseen dangers lurking in the financial system. So today, we're doing a deep dive into this really intricate world of economic policy shifts. We're going to unpack how central bank actions, government interventions, things like interest rates, tax cuts, tariffs, even immigration policy, how they impact everything, from your wallet right up to the national debt. Our mission, really just to distill the key insights from all these different sources we've looked at, help you understand the real-world consequences, the good and the bad, of pulling these powerful economic levers.
And to help guide you, we've drawn from quite a range of sources. We've got detailed economic analyses from places like the Hoover Institution, financial market reports, direct commentary from economists, political figures, too. They offer a whole spectrum of perspectives, really. We'll try to highlight what's most important and, connect the dots so you get the full picture.
Okay, let's start with the Federal Reserve itself.
Yep.
That balancing act they do. Their main job, as most people know, is keeping prices stable and employment high, usually aiming for around 2% inflation each year. They mostly do this by fiddling with interest rates and the money supply. But what actually happens when rates stay low, like really low, for a long time?
It sounds good, Ray.
Cheap money.
Well, it sounds good initially, but what's fascinating and what our sources really dig into are the let's call them unintended consequences of keeping rates persistently low over long stretches. Take housing affordability. Yes, lower rates mean lower borrowing costs, but they also let households take on more mortgage debt. And when everyone can borrow more, that boosts demand, and it drives up home prices faster than people's incomes are rising. So the insight here is kind of paradoxical. Low rates can actually make housing less accessible for many over time.
That's a really key point. So it's not just helping people get loans, it's changing the whole market dynamic.
Exactly. And our sources show this generational gap. Like for millennials in 2017, it took about 13 years to save a down payment for an average house. Compare that to baby boomers in 1976, it took them about 5 years. That's a huge difference. And millennials tend to carry more debt overall, which makes them more vulnerable if or when rates eventually go up.
Wow, 13 years versus 5. That really puts it in perspective. So these low rates, they don't just hit mortgages, they ripple out into investments too.
They absolutely do. See, lower interest rates mean lower discount rates. That's basically the way we value future earnings today. When discount rates fall, future profits look more valuable now, which tends to push up stock prices. And here's the thing. Equity prices, stocks, they've grown much faster than wages. Think about it. One source mentioned the Toronto Stock Exchange growing at 8.1% annually versus maybe 2.8% wage growth over 20 years. Since higher income earners are more likely to own stocks, this gap tends to benefit the wealthy more, potentially widening that wealth inequality gap we hear about.
So the policy, even if well-intentioned, might be contributing to that inequality. That's quite something. And there's another term I found interesting in the research. Zombie companies. What's that about? Low rates creating zombies.
Oh, it's a stark term. Yeah. When credit is super cheap and easy to get because of low rates, it can prop up companies that aren't really performing well. These are the zombie companies.
Yeah.
Businesses that, in a normal market with higher borrowing costs, would probably fail. But cheap money keeps them afloat. The problem is, This stops resources people, capital, assets, from moving to newer, more productive, more innovative companies. It kind of slows down that natural economic churn and can actually hinder overall growth and productivity.
So it keeps inefficient players in the game longer than they should be.
Precisely. And it also creates clear winners and losers. Borrowers. They win, they get cheap credit. But savers, especially retirees relying on fixed income, they lose out because they earn much lower returns. It forces savers to either take on more risk, chasing higher yields and potentially riskier assets, or they just watch their savings effectively shrink in value.
Right. That search for yield can push people into investments they might not fully understand. Okay, so it hits individuals, businesses. What about the government itself? Does cheap money change how governments behave?
It certainly can. The sources suggest low rates create what they call a perverse incentive for governments. Basically, when borrowing is cheap, it's easier for governments to take on more debt without the immediate pain of high interest payments. This raises some serious questions about intergenerational fairness. Are we racking up debt today for current spending, leaving future generations to deal with it, especially if it's not debt used for, say, long-term productive investments?
That's a heavy thought. Okay, let's shift gears slightly. Still talking about money, but that common idea, maybe simplistic. Why not just print more money if the government needs it? Our sources really push back hard on this. Why is that such a risky idea? Let's talk inflation.
Right. And some sources, like one called The Stupid Economy, lay it out very clearly. Printing tons of money without a matching increase in actual goods and services being produced, well, it just makes the money you do have worth less. It devalues the currency. Prices go up because there's more money chasing the same amount of stuff. And if it gets out of control, you risk hyperinflation. Look at Zimbabwe in the late 2000s. Prices were doubling daily. Money became worthless. It completely crippled the country. When prices rise way faster than wages, people can't afford basics, savings get wiped out. It's devastating.
So money needs to represent real economic value, not just be printed on demand. Okay, now this next bit gets really political, moving from the mechanics to the pressures. We mentioned President Trump publicly criticizing Fed Chair Powell, calling him slow, demanding significant rate cuts. Why is that kind of political pressure on the Fed seen as such a big deal? Why the emphasis on Fed independence?
Well, the independence of the Federal Reserve is widely seen as really crucial for economic stability. When political leaders publicly criticize the Fed, or suggest firing governors, or pressure them to ignore inflation, it creates uncertainty. As Ken Griffin warned, it can actually lead to higher inflation and higher long-term interest rates because markets get nervous. It increases risk premiums. Investor confidence in U.S. institutions can weaken, both here and internationally. You even had figures like Christine Lagarde at the ECB warning that this kind of undue interference is a serious economic risk, not just for the U.S., but globally.
So history shows this can backfire.
Yes. There are historical parallels. Think President Nixon pressuring Fed Chair Arthur Burns back in the early 70s. That period was followed by significant inflation. The worry is that this kind of pressure risks doing structural damage to the Fed's ability to manage the economy and pursue its goals, keeping employment high and prices stable.
Okay, so Fed independence is key. But the Fed isn't the only player. Government, fiscal policy, taxes, spending, trade, that obviously shakes things up too. Let's look at President Trump's proposed platform, which leans heavily on supply-side economics. What does that involve?
Right. The Hoover Institution did an analysis we looked at, an even-handed analysis of Trump's economic policies, which gives some good context. During his first term, you had the 2017 Tax Cuts and Jobs Act, CCJA, plus a big push for deregulation. The analysis notes this did boost business confidence quite a bit. Business investment went up, GDP growth accelerated for a time, fewer businesses were citing regulations as a major concern. The core idea of supply side, pushed by economists like Arthur Laffer, is that if you reduce the tax and regulatory burden of businesses, they'll be incentivized to produce more, expand, hire people.
Right. The idea is to boost the supply side of the economy. Cut taxes, cut rules, and growth follows. Sounds straightforward.
Well, that's the theory. But there are criticisms, of course. A big one is that these kinds of tax cuts often don't pay for themselves through increased growth, as proponents sometimes claim. Instead, critics argue, they tend to increase government deficits and the national debt. For example, those individual tax cuts from the 2017 law, many are set to expire at the end of 2025. Just extending those is estimated to add something like $4.5 trillion to the deficit over 10 years. That's a huge number.
$4.5 trillion. Wow. And who benefits most? Is that always spread evenly?
That's another point of debate. Critics often argue these cuts disproportionately benefit higher-income taxpayers and corporations. Sometimes companies use the extra cash from tax cuts for stock buybacks, which boosts shareholder value, rather than, say, investing in new factories or significantly raising wages for rank-and-file workers.
Okay. And deregulation is the other big piece of that supply side push, right?
Yes, absolutely. The platform anticipates a significant shift toward deregulation across many sectors: energy, auto, pharma, finance, housing, labor. The expectation is that this lifts business confidence, encourages investment and expansion, leads to more hiring. However, there's a note of caution in the sources too. While there might be talk of improving government efficiency, claims of saving trillions through that alone are called misleading, unless there are fundamental changes to big entitlement programs like Social Security or Medicare, and that needs Congress to act.
And sometimes deregulation or budget cuts have direct impacts people feel, right?
They can. For instance, the sources mentioned a $6.8 billion freeze on federal education grants back in July 2025. That sparked lawsuits from over 20 states plus D.C. because of the predicted impact on things like after-school programs hitting vulnerable communities. So there are always trade-offs.
Definitely trade-offs. Okay, let's talk tariffs. This is always a hot topic. President Trump has proposed some really big ones: 10% on all imports, 60% on goods from China, even potentially 30% on imports from Mexico and the EU. What would that actually do?
Fundamentally, tariffs are just taxes on imported goods. So they raise costs for businesses that import things, and those higher costs, they generally get passed on to customers as higher product prices. That's the consensus in the analysis. So imagine a 30% tariff on Mexican produce like avocados or tomatoes or electronics or even tequila, or on medical equipment or cars from the EU. Those higher costs would likely show up on price tags here in the U.S.
So we, the consumers, end up paying. It's not really paid by China or Mexico.
Largely, yes. The cost tends to fall on the importing country's consumers and businesses. We saw this happen already back in July 2025. The administration put a 17% tariff on fresh Mexican tomatoes. That cost gets baked into the price you pay at the supermarket.
Right. And beyond just higher prices, what were the broader economic effects of the tariffs during Trump's first term, according to the sources? Did they achieve their goals?
Well, the analyses we looked at suggest the tariffs imposed then on about $380 billion worth of goods, mostly from China, actually harmed economic performance overall. They messed with global supply chains, international trade volumes flattened out, corporate profits took a hit, and importantly, the sources say they did not achieve Trump's stated objective of bringing manufacturing jobs back to the U.S. in large numbers. They also did not reduce the trade deficit. In fact, it actually widened.
So the opposite happened with the trade deficit, and manufacturing jobs didn't surge back.
Manufacturing employment had seen a bit of a boost earlier, possibly from the tax cuts and deregulation, but the analysis suggests the tariffs actually reversed those gains. Plus, there's always the risk of retaliation, other countries hitting back with their own tariffs on U.S. goods. That risk is maybe even higher if those countries have weak economies and rely heavily on exports. It can escalate quickly.
Okay, tariffs seem complex with lots of potential downsides. Let's touch on one more major policy area: immigration. Headlines recently mentioned the administration expanding deportation powers, allowing removal with very short notice, and proposals for mass deportation efforts. How does immigration policy intersect with the economy?
It's obviously a very politically charged issue, but purely from an economic perspective, the sources we reviewed state pretty clearly that immigrants, both documented and undocumented, generally contribute positively to the economy. They fill jobs, they earn wages, they spend that money, and over time they tend to increase labor productivity.
So the argument is they add to the economy. What about the risks of policies focused on mass deportation?
The sources flag economic risks associated with proposals for massive deportations. One example cited was from Newsweek back in July 2025. It reported that nursing homes were facing deepening workforce crises because of immigration restrictions.
Yeah.
They were losing foreign-born workers they rely on, with few prospects for replacing them. Now, in reality, logistical challenges, costs, legal hurdles often mean the scale of deportations doesn't reach the level of campaign rhetoric. But even so, the macroeconomic impacts can be significant, especially in sectors like agriculture, construction, or healthcare that rely heavily on immigrant labor.
And politically, how have those policies been received?
Interestingly, public support for the administration's immigration policies apparently saw a significant dip around July 2025, hitting a net negative 27% rating, the lowest of the second term up to that point. This followed reports of mass deportation efforts and controversial ICE raids. So there's an economic angle and a public opinion angle.
Okay, we've covered a lot of ground here. From the Fed's interest rate tightrope and inflation worries to government levers like tax cuts, deregulation, those controversial tariffs, and immigration policy. What's the big takeaway when you put it all together?
I think if you zoom out, the big picture is that these economic policies, whether they come from the central bank or the government, they're incredibly powerful tools, but they're also quite blunt. They almost always involve trade-offs. There are winners, there are losers, and there are nearly always unintended consequences that ripple out. They affect different groups very differently. Homeowners versus savers, importers versus domestic producers, current generations versus future ones. Trying to achieve economic growth and stability is this constant, really challenging dance between all these different forces and policy choices. And the decisions made today, they really do echo for years, even decades.
That's a great summary. It truly reveals that every economic choice sends ripples through the system, often in ways we don't immediately see. Which leaves a big question for you, the listener, to think about. How do we strike that difficult balance? The balance between wanting immediate economic relief or growth and ensuring the long-term health and stability of our financial system and indeed our society as a whole. Keep learning, keep asking questions, and stay informed.